Good morning once again, everyone, to our weekly broadcast on behalf of Leo Crowdfunding and Property Fortress. Delighted you could join us once again for our 30-minute look at the market with special guests and all things educational. I've actually flown in this morning from Belfast to Liverpool. I'm sitting in a boardroom of a company that I'm here to meet right now, so not my normal setting, but looking forward to getting on the broadcast. So my name is David Johnson. I'm the CEO of a company called Leo Crowdfunding. We're an equity property crowdfunding platform, and we put this webinar on in conjunction with our partner for this project, Mr. John Corey. John, over to you to say hello.
Good day, everyone. Interesting, David, just to come back to you slightly. Your normal setting looks completely normal to me. So you don't know that you're in a normal setting, but the rest of the world thinks you are. So exactly. Just quick introduction, John Corey, Property Fortress, folks, US, UK, when it comes to buy and hold landlord. Been doing this for a little while, hence the gray hair. And we'll get into a few things about that perspective when we get into the 10, 20, 30, 40-year inflation trends.
Exactly. It's good to have you back on. Obviously, for those that don't know, based in the US currently, and you aren't due back over to the UK, are you, on a trip, or has that been delayed?
Well, it keeps getting moved around. It's slightly or heavily tied to my wife's schedule. So until she can settle down what her plan is, the intention was like somewhere around now through the beginning of November. So we'll see if we squeeze that in before getting back here for the end of November.
Yeah. What would be cool is to do one of these with both of us in the same room on the same camera. I think that would be interesting.
We've never done that.
No, that's what I'm saying. That would definitely be a first. Delighted to have on Iain Cartmill this morning. Good morning, Iain. How are you?
Yeah, good morning, David. I'm living in Switzerland, in Zurich at the moment. Originally Australian, have lived in other places as well, now living in Switzerland, in Zurich for many years. Private investor. I was in funds management, hedge funds. Now I'm trading my own account and active property investor as well.
Fantastic. I'm really looking forward to picking your brain from your expertise and the journey you've been on. You're obviously a Chartered Financial Analyst, which we'll come to in a few moments. So great to have you on board for today. So a couple of very quick sort of housekeeping things, and then we'll move straight into our important discussion today. If anyone does have a question or a comment, then please do add it into the Q&A, and John and I can pick that up. So always keen to hear people's views on things or to ask a question, particularly of Iain today. If you've got a specific question about some of the technical detail around the discussion, then yeah, the only stupid question is the question not asked. So please feel free to do that. Market update. Again, there's any amount of these, John, that we could pick up, but I think this one just again kind of caught my attention that despite so much negative press over the last probably 68 weeks, UK house prices in October actually continued to rise slightly. Doesn't mean there's not a correction coming down the line, but it is interesting that the economy actually hasn't been in negative for the last couple of months either. So it's kind of like, are we just waiting for the off the edge of the cliff, or what's your thoughts?
I think people overanalyze this at some level. There's a lot of stuff that goes on. Schools started, children are off, university students are off, people go to work. Even in the deepest, darkest days of the Great Recession, or whatever it was called in 2008, 90+% of the UK population went off to work every day. So you should pay attention to the news because it affects what other people are thinking, but I wouldn't overinterpret any of this.
I think one good indicator of perhaps where the market's going is that, according to this this article from The Guardian, about 1,000 mortgage deals were removed by lenders last month. So that, I think, is significant, that there's definitely tangible, confirmation of turbulence, if you like, in that market. Now, whether they're pulled completely or pulled just to be like different terms sent out, and there'll still be lending, but just a slightly different terms. I suppose time will tell, but I think that does indicate that there's definitely turbulence.
It's a repricing exercise. They were pulled and then new loans are released as they digest the wholesale market pricing. So it's, it's like they changed all the price tags and all the things on the rack, but the stuff's still on the rack. So
yeah. When I was talking to Stefan Canavan there, I think about 2 weeks ago on our project committee, and he alluded to that very sort of frustration that he had, that the mainstream media carried, all these different lenders have pulled all their project or all their products, and this was a catastrophe and doom and gloom. He said, but literally all they did was reprice them, put them back out again. It wasn't that they weren't lending; they just made some tweaks to the terms. So, Iain,
it needs to be understood that lenders don't have money. They go out to the wholesale market and they buy that money. So when the people selling them the money up the price, they have to then change their prices. So.
That's a good point. Yeah, and understanding that. So, okay, Iain, this is obviously sort of UK where we are at the minute in terms of the information. But what's happening in Switzerland in terms of house prices, or any sort of takeaways you can give us?
Yeah, I was just going to follow on from John's point. I mean, what we've seen over the last month or so is not really reflecting on the be it strength or weakness of the UK property market. It's what's happening on the funding side for banks and other financial institutions that lend to the residential market. If you're not certain about how you can fund your book, be it from deposits or having to go into commercial markets to fund your book, then overnight you can decide this is not a market we want to participate in and stop what you're doing. And then when you've got a better handle on what's going to happen on the policy side from the UK government or from the UK Reserve Bank, then you're in a better position to make a call. But yeah, I mean, in Switzerland and maybe a little bit more generally in Europe, I mean, we haven't seen such a great policy change. So as a result, people aren't so worried about some sort of policy error. So no, nothing's really changed in terms of affordability or access to residential mortgages. In terms of the pricing, for sure, that's gone up a little bit, particularly as rates have started to rise. But by and large, we haven't seen this sort of turmoil that you might have seen in the UK.
Yeah, and that's probably partly driven, I guess, by the uniqueness of the UK media, but that's a longer discussion probably than for today.
But it isn't, David. It isn't. It's got a lot to do with the money. So I think one thing that Iain could comment on, and we don't need to go into, but is they have multi-generational loans in Switzerland because house prices are high there for locals. So you have this long-term fixed loan that might be like 90 years. So
yeah. There's a lot more stability in the market, and because of that, I mean, people can rely on the value of their properties to be quite stable over time. It doesn't mean that in Switzerland and other countries you don't have booms and busts, but they're a lot more rare. I mean, for example, in Switzerland, you don't have to pay off your mortgage by the time you retire. A lot of banks will accept that you might be able to pay down until 2/3 of the balance of your loan still exists, and then your pension, earnings and what you receive from the government when you retire will cover the rest. So quite often, there's no sense that by the age of 65 you have to have paid off your house and have it debt free.
Interesting. No, it's definitely interesting difference. Okay, so just a couple of quick updates for attendees who particularly are on the Leo crowdfunding platform as a fundraiser for investors. So we do have a project that's currently live for investment on the platform. Dunlickety up in Scotland, a beautiful location near Inverness. This is a service accommodation sort of income project. So literally we'll be generating some profit almost day one immediately. So it's just literally open live. People can go to the forum where there are a number of questions that they can look at. We did run project webinar. Those questions are now on the forum, so you can have a look at those. And of course, you can download the equity offer document and have a look at this project. So it's very much a project over 36 months. There's initial profit share from the rent, also potential of capital growth. So John, I know obviously you've been involved in this one. Do you want to just comment quickly on it?
As you just said, there's essentially three main buckets: the ongoing income from the service accommodation rental, the upside from the revaluation of the property once it has established books and records as a commercial property, and then the development potential. There's multiple different development opportunities on the main site and the periphery sites, and all of that's detailed in the offer documents. If people are interested in an asset or a project that has cash flow plus development upside over the next 3 to 4 years, 36 months, if as it says there, then take a look.
Yep, so you can grab the document, you can go to our YouTube channel and see the project webinar as well. If you have any questions on this, you can reach out to Dal and he'll happily answer them. And yeah, looking forward to this one progressing and obviously moving towards funding. There are 2 other projects that are currently coming soon on the platform. We have Becontree Avenue in Dagenham. This is the PLMD. This is actually tranche 2 of a previous raise. So it's 9 apartments in London, estate agent downstairs, and it is a raise that's coming as a second part of what was already there. So they paid out dividends already, slightly ahead of their projections. So keep an eye out for that when it goes view data live for investment. We've also got a Stafford Gardens in Catteringham. This is a planning uplift project, and again, the details of that will be viewed in quite soon. But it's an opportunity to be involved in covering the cost of the planning. And usually the return on this is a lot higher than ordinary development, but of course it does come with risk as well. So a number of projects, other projects being prepared as well. So there'll be plenty of choice for investors as we head towards Christmas. Now, on the 3rd of November, we're actually running a Leo Crowdfunding PLMD joint networking event. This will be in Stratford. We ran one of these about 2 months ago and it proved very successful. Only 50 people attended. So the Becontree shareholders will have a shareholder meeting. First of all, there'll be some refreshments and then an open networking session where AJ from PLMD will do a bit talking about the uncertainties of the market. And myself and Dal Ray will also have short slots, a bit of a panel, but really it's about networking. It's about getting information about what's happening right now in the market from people who are actually in the business, developers and investors. So if you're interested in going to that, reach out to us, to Dal. There is an Eventbrite. You'll find us there as well. And you'll be able to come and join us. So let's just get into our topic today. And I'm really looking forward to today. Not just because of the topic, but also because of our guest today. So Iain introduced a little bit of himself there a minute ago, but Iain's actually on our advisory board. Someone I've got to know now for a number of years, very experienced in the world of property investment, and knows a lot about crowdfunding in the UK. But you want to just remind people, Iain, about your background before that in terms of your sort of main history, and then we'll dive into this important topic.
Yeah, sure. Born and grew up in Australia. Did a degree in economics and geography at university, then worked in banking for 4 years or so in Australia. Moved to the UK, worked in investment banking, middle office, product accounting for a couple of years, then moved to Switzerland and then moved over to the buy side asset management business, running long only equity funds and then long short equity funds. And then I stopped doing that in about 2016 and started managing my own investments on a full-time basis. So these days I have rental properties in Switzerland, in the US, in the UK, and I have, I'm actively involved on several crowdfunding platforms in the UK. And then apart from that, I do some, investing, shall we call it, investing trading in equities mainly in the US and in options mainly in the US.
Cool. So no better man to be talking about inflation and the property market. So this obviously is a hot topic at the minute. Do you want to just start off, Iain, maybe like, what is inflation? For the layman out there, here's all this, but could you even just give a quick sort of description of what actually is it?
Yeah, it's a general rising level of prices of goods and services in the economy. Probably the first thing I'd like to say, and probably the most important thing I'd like to highlight, is that it's not usually a scary thing. I mean, usually you want a little bit of inflation, and generally it's accepted that maybe 1 to 2% of inflation per year is important, because it greases the economy, if you like. It makes things work better. So people shouldn't be scared of a low to moderate amount of inflation is a normal thing. And probably the other thing I'd like to mention is that like I said, inflation is a general raising of the price level of goods and services, and that includes house prices as well.
Okay, yeah, that's got a slide coming up regarding relevant to that. John, just in terms of any comments you want to make on inflation, but I know you're quite into things like decision making, and so who within the UK decides the interest rate, which obviously then kind of affect inflation. It's one of the levers that's used, and how important is that control in terms of inflation?
The general principle is the central bank of a country sets the base interest rate, or the interest rate for the government debt. And if you take the view that if the government defaults on its debt, we're in trouble, in that country at least, then the assumption is the least risky debt that you could buy is government debt, particularly if it's the same country that you have all your bills in and everything else, so that you're correlated, and at the same time you have the least risk of default. So everybody else tends to price whatever they're doing as a premium on that no risk debt. So the Bank of England in the UK would set the interest rates or the base rate, and lots of other people then get an opportunity to reset their risk, their debt, their offering, whatever. In particular, what this means is if the Bank of England changes the interest rates to dampen down inflation by raising them, then you'll see that ripple through. It's not the government, it's the Bank of England. It's not the government either when it comes to a lot of other things. It's the marketplace reacting to the government, but also reacting to the Bank of England. So you could argue the bond market sets interest rates for most of us.
And is that, for both of you, Iain and John, is that a good thing or a bad thing? Because people who are unelected in a country, in terms of the bankers, actually can effectively control the economy, as probably Liz Truss has found out to her detriment over the last number of weeks. So is it a good thing or a bad thing?
Possibly she should read history. Historically in the UK, it was tied to the government. It was actually a political decision, and that didn't necessarily go very well. So it was a conservative government decision, which was well received around the world, to make the Bank of England independent when it comes to setting in interest rates. They were given a mandate of an inflation target. As Iain said, a positive inflation rate is generally a good thing. So they were asked to try to hit 2%. And therefore, it's a decision that's not subject to political whims and which way the wind's blowing.
Any views, Nadia?
Yeah, no, I'd have to agree with all of that. The only thing I'd say is that, these are appointed officials, but I mean, what you do tend to find is that they're very highly qualified people who have been, have had successful careers, right? So I mean, they should know what they're doing. The only problem in the whole setup of this thing is that monetary policy is a very blunt tool. Everyone expects it to be, a silver bullet, and it's not. It's, it can have delays. It may not work at all. It could work overnight. No one really knows. But the general premise is that, it's widely accepted that, it's a slow moving tool, and you always find that people are asking too much of it, and it's quite unreal.
Yeah. I mean, I fully understand and agree to your point about these people are qualified, these people are the experts, but what about the argument that these people were in charge of the US market, the UK market before the crash, and didn't see what was clearly coming down the train tracks of a huge crash?
That was completely false, or that's like saying because the plane crashed, the car companies didn't design right. There was no connection. The Bank of England doesn't manage essentially the financial markets. It's mostly the Treasury, that's the PRA, while the B of E has a role to play when it comes to the monetary policy and the interest rate. There's very little connection between bad regulatory decisions and what the interest rate is.
Okay. So in terms then of this inflation in the property market, we're currently in a a rising inflation currently. What's around about 10% is at the minute? Did it go up slightly there recently? So around about 10%.
Yeah, I think it's 10 most recently, or very close to that.
So if someone is thinking from an investment point of view, Iain, and obviously this is you've done all your life, and they're thinking, oh, the market's a bit turbulent at the minute, I'm just going to leave my 50 grand in the bank. What impact does inflation have on that 50 grand sitting in the bank?
Well, I think there's two things. I mean, obviously, you're losing the real purchasing power of money that is left in the bank, and there's also an opportunity cost because you're not earning any interest on it these days. But then the second thing is that you got to understand that there's a lot of uncertainty that comes from actually investing as well. So, I mean, as much as you're suffering an opportunity cost, that may sit better with you if you're really worried about what's just around the corner in the short term. So it creates a lot of uncertainty that what's going to happen, what the politicians are going to do, even what central banks are going to do.
And if we take the market over a long period of time, John, this is one of your favorite mantras. It's, I think, the very first broadcast we did back in March 2020. You've mentioned this numerous times about the long-term view as opposed to short-term sort of analysis of a given situation. So if we take inflation, in the UK back as far as the 50s, I mean, we're currently around about 10%, but there's been, certainly periods in the past where it's been higher, and in some cases nearly double what it is now. So how important is this long-term view? And I mean, can you remember back much whenever I was obviously too young, but can you remember back what it was like when inflation was actually double what it is now, and what impact did that have on the property market?
So on one level, yes, I can remember, but I was in high school. So if we look at this timeline, it's almost exactly when I was born to now. I wouldn't say that the first part is something you would remember. You're in the more part. My professional career is the more stable part. I started property investing in '83. Now this is the UK interest rates. The US was broadly similar. I think it's in '76. Technically, the UK went bankrupt and it needed an IMF bailout. First European country to get bailed out by the IMF. So there's a lot going on in those spikes. There's a lot going on in those peaks. There's 3 days a week they could keep the power on. 4 days a week they had trouble with getting the trash picked up, and all those stories. Those are those peaks. So there's an awful lot that happens that's pretty negative day to day when your economy is facing 25% inflation. Now, if you have assets that go up in value when the currency goes into the toilet, well, okay, 25% toilet flushing is possibly very good for your assets. And property's been one of those assets that does well in inflationary times. It should be noted, though, it doesn't do well immediately. It takes a little while. It's a good inflation hedge, but just because inflation spiked up doesn't mean property prices rose directly with it, because it comes down to what does someone have in their pocket to pay the monthly rent or the monthly mortgage. It takes a little while to factor through. So inflation is more like the weather. It's part of the environment. And as a property investor, you have to accommodate the weather That's why we have roofs on our houses to stop the rain from coming in. Well, inflation is one of those things that's going to affect you. So how do you position yourself so that you're at least neutral or sort of able to survive? Maybe take a bit of a hit, but you don't get completely soaked.
And Iain, John made an interesting point there about there are some asset classes that actually can have a benefit from inflation, rising inflation. So I think from a property point of view, that's a really interesting point. Do you want to just maybe explain why, obviously, if someone has a mortgage, for instance, why high interest rates or high inflation isn't necessarily a bad thing?
Yeah, I mean, and we see this in the broader market as well. It's not just residential, but I mean, there are differences, depending on which part of the property market you're in. With looking in a bit more specifically into residential property, you got to understand a bit what's driving the market, but also what's driving the inflation. And on the two sides of inflation, there's demand pull and there's cost push. Cost push is not so good because you're increasing the price of something because your costs of producing that are going up. That may not be such a good thing, and that may not be such a sustainable thing. What's good and what I see a lot of in the current environment that's driving inflation is the other side called demand pull. And you're seeing this because there's a scarcity, for example, in the residential property market that's driving prices up. There's also low unemployment. There's also rising wages. And believe it or not, the weak pound is also probably good for the stock market. For the property market, because foreign investors find it cheaper to invest in the UK, and also maybe people who live in the UK are finding it less affordable to travel abroad to go on holiday, for example. So they're staying more locally. So that's also important for the property market. So for the residential market in the UK, I mean, inflation is probably a good thing because there's a lot of demand pull. But maybe in certain other sectors, maybe in commercial property or maybe in office, maybe those dynamics aren't so strong, and maybe there's a bit more cost push inflation and maybe a lot less demand pull. For example, like central office space, for example.
Okay, no, very insightful. Thank you for that. Last slide then before we sort of head towards wrap up. I find this one interesting, although I don't profess to have understood every last part of it. But the inflation-adjusted housing index, it was interesting that obviously if you go back in the 1900s, property didn't really have a value in the UK. I suppose in most parts of the world, it's something that is relatively new in history, where you have an increasing value of property as an asset. And then
So wait a minute, David. Property had a value, just didn't bounce around as much.
Yes, okay. But it's also very low value initially in history.
Or you could argue the sterling was strong and you didn't need much of it to buy a house. And now sterling's in low value, relatively speaking, and therefore you need a lot more of that crappy paper.
Yeah, if you look at the average house prices, John, in history of almost any country you choose, like it never started way up here and come down and back up. It's this constant rise upwards from a relatively, I would say, a relatively low period.
That is inflation, because we're measuring it in this thing that keeps going down. Yes,
exactly. So, so in terms of this slide in front of us, I know Iain, you made a comment, I guess, where we're sort of warming up to go on air about even sort of questioning the value of a slide like this. But what were your thoughts on this type of adjusted housing index?
Yeah, I mean, in my view, I mean, inflation is usually a good thing because it's rising asset prices, and houses are an asset. So why you want to remove that effect? I mean, apart from looking at something very specific. I mean, for example, maybe you want to remove the effect of energy prices. I mean, like, because a lot of what we saw in the early and then in the late 1970s was driven by the energy crisis. So if you wanted to remove that specific effect to see what was otherwise happening to the property market, that might be a useful exercise on a very specific time frame. But more generally, I mean, you, as a property owner or a property investor, you want to see some inflation.
Yeah, John, any takes on this this slide? Any comments?
Not really, other than it's good if people care about this to dig into what was going on around those specific events. You'll find that, like the Vietnam War, the US moving off the gold standard, inflation getting out of control because inflation was controlled by politicians and central banks weren't independent. This switch to independence happens generally in some of these crisis points.
Okay. So yeah, that's an interesting sort of snapshot, and I think that's the key thing for me in this topic. And so much of your property is it's long-term view as opposed to short-term panic over a change. That's kind of the big takeaway.
I want to caution people though that higher inflation is extremely painful in that, you know, your ability to adjust and do maintenance and pay the rent or pay the mortgage, these things that will whip you around. It's not that inflation is bad in the core value, but it's more that inflation is going to cause you to have turbulence and make it difficult to predict what you're going to need for a buffer, what it's going to cost you to replace a boiler, that sort of thing. So it's a very painful time generally to live through when it comes to high inflation because stuff's moving all the time.
Yeah. Question just in, Ian, we can make this the last before we wrap up. Why is commercial property more cost push and more likely to be negatively impacted by inflation?
Because a lot of what I see is that there's not really much demand pull. You know, you have more work from home, you have corporations downsizing. You know, generally, you know, corporate earnings are okay, but they're not great. There's less demand for commercial, for office buildings at the moment. So any rise you're seeing there is probably 100% due to the cost side. But what we're actually seeing is falling values because, you know, there's much higher vacancy rates. That's causing, you know, a lot more pressure on yields as well.
Okay.
There's another angle too, which residential property is based on occupancy from an owner occupier. Commercial property is priced on the capitalization rate. Essentially, when you do the math, that's tied into the Bank of England's base rate and the risk-free return. So if the base rate's going up, then the capitalization rate has to be adjusted, and that will depress or reduce the value of commercial property in the short term. So the rents catch up.
Excellent, thank you. Ian, any last sentences you want to leave on this topic?
Yeah, no, just go back to the slide you had before. I mean, something that's important there is that, I mean, most politicians and most central bank officials, no, sorry, a couple of slides before the last graph, haven't really had much experience into, you know, what we've been, you know, we're dealing with right now. I mean, for the last 40 years, it's been quite a low contained sort of, no, the one before, David, it's been like quite a low contained inflationary environment. And I think why the US Fed were so slow to act is that you know, they're fearful of making a policy error there. So if you don't really know what you should do, then the best thing is to do nothing. And then for us as investors, I think, you know, basically you've got to, you know, you don't do as much risk taking as you might do in normal times. I mean, I think it's still good to invest in property, it's still good to invest in property projects, be a little bit more conservative, but you know, making sound decisions and not decisions just based on the short term.
Yeah, no, I think that's good. A good take on things. So just before we move to wrap up, I'll just obviously give the normal caveat. Obviously, when we bring guests on and you know, comments are made, they're not necessarily the views of Leo Crowdfunding. None of us here today are trying to give financial advice or in any way trying to steer people towards investing. That's an individual decision for each investor, and of course, investment does come with risk. So Ian, thank you for that, and John, again, always interested to hear the thoughts on that. So I think that was really interesting just to get the perspective on what's going on and sort of the story behind the headlines. I sometimes call it. It's easy to read a headline in a paper about inflation, for instance, but what does it actually mean to investors and the world of property. So absolutely brilliant. Thank you for that. Next week's topic, we're actually going to have like a double header coming up. So next week, we're actually going to look at equity offer documents and financial promotions, following on from the Harlequin owner being jailed for 12 years, which we talked about last week, for breaching financial promotions and the fact that they're running a collective investment scheme. As a 70-year-old, he's now facing justice and is looking at a 12-year sentence. So we're just looking at why these equity offer documents are so important to get right, and why they then can be approved as a financial promotion. So we're going to be talking about that, and really this is around being fair, being transparent, not misleading, or the sort of compliance buzzwords. So John, this will be an interesting topic, and in the following week we're going to have a lawyer, David Wilby from Lewis Silkin, is going to be on talking about the importance of agreements in property, as well from an investor point of view, not just a fundraiser point of view, particularly around shareholder agreements in this type of equity investing. So promises, John, to be an interesting and very worthwhile topics the next 2 weeks.
Yeah, I think the three key words there are fair, transparent, and, well, 4 words, not misleading. This is ultimately what the FCA is saying, is the information presented has to be reasonable and useful so that the person reading it can make a decision. There is no predictive ability. There's no assumption about if you're FCA compliant, it's a good investment or a bad investment. It's just, is the information fair? Is it transparent? Can people form an opinion on their own situation, their individual situation, based on the information they're being provided?
Yeah. So look forward to that. That'll definitely be useful. So that's all for today. Thank you very much, everyone, for joining us. Again, should be up on our YouTube channel within about an hour normally, all things being equal. And you can find our YouTube channel there on the screen, youtube.com/LEOcrowdfunding. So
do we have Joanna's case study?
It is not on the actual platform. No. So I knew you would slip that in towards the end of the broadcast today, just to have it on the recording. So there'll be some communication with Joanna, no doubt, today and the team. So fantastic. Listen, Iain, massive thank you for joining us today. Hope you enjoyed your time again. It's probably been about 7-8 months since you were last on, maybe last year since you were last on. Yeah,
I think so. Yeah. No problem. Happy to be here.
Yeah, absolutely fantastic. Lovely insights. And thanks again, John, for being here. And we will see you again next Thursday. All the best, everyone. Stay safe. Good luck. Bye-bye.